Unveiling the mystery, Cybersecurity ETFs explained. Hey everyone, welcome back to Chat ETF. Today, we're diving into the world of cybersecurity and how you can be a part of it through investing. That's right, we're talking about cybersecurity ETFs. Maybe you've heard the term thrown around, but what exactly are they? With cyber attacks becoming more common, the need for robust security solutions is skyrocketing. Cybersecurity ETFs offer a way to tap into this growing market, but there's more to it than meets the eye. Stick around as we unveil the mystery of cybersecurity ETFs. We'll break down how they work, the risks involved, and even explore some options with lower fees. Question 1. What is cybersecurity ETF? A cybersecurity ETF, or exchange-traded fund, is an investment vehicle that tracks a basket of stocks from companies involved in the cybersecurity industry. In simpler terms, it allows you to invest in multiple cybersecurity companies at once through a single fund. Here's a breakdown of what a cybersecurity ETF offers. Exposure to the cybersecurity industry. The core idea is to provide investors with a stake in the growing cybersecurity market. As cyber threats become more prevalent, the demand for cybersecurity solutions is expected to rise. By investing in a cybersecurity ETF, you're essentially betting on the future of this industry. Diversification. Instead of picking individual cybersecurity stocks, which can be risky, a cybersecurity ETF holds shares of numerous companies in the sector. This diversification helps spread your investment risk. Even if a few companies underperform, the overall performance of the ETF is less likely to be significantly impacted. Focus on different areas of cybersecurity. Cybersecurity ETFs can be designed to track different segments of the industry. Some may focus on companies that develop security software, while others might target those providing security services or hardware related to cybersecurity. This allows you to choose an ETF that aligns with your investment goals. Question 2. What is the cybersecurity ETF's primary investment objective? The primary investment objective of a cybersecurity ETF is to provide exposure to companies that are involved in the cybersecurity industry. This translates to aiming for the ETF's overall performance to reflect the growth and health of the cybersecurity sector. Here's a deeper look at how this objective is achieved. Tracking a cybersecurity index. Most cybersecurity ETFs don't directly invest in individual companies. Instead, they track a cybersecurity index. This index is a benchmark that includes a basket of stocks from companies within the cybersecurity industry. The ETF aims to mirror the performance of this index by holding shares in the same companies, with weightings proportional to their representation in the index. Exposure to industry growth. By tracking a cybersecurity index, the ETF offers investors a chance to capitalize on the potential growth of the cybersecurity market. As cyber threats increase and data security becomes more critical, the demand for cybersecurity solutions is expected to rise. This, in turn, could lead to positive performance for companies in the industry, which would be reflected in the ETF's overall value. Examples of tracked indices. Inc. Cybersecurity Index. This index is followed by ETFs like Global X Cybersecurity ETF, BUG. It focuses on companies involved in developing and managing security protocols. NYSE FactSet Global Cybersecurity Index, tracked by ETFs like ETFM International Cybersecurity ETF, IHAK. This index includes companies from developed and emerging markets that operate in the cybersecurity space. Beyond index tracking. While most cybersecurity ETFs passively track an index, there might be some variations in their specific objectives. Some ETFs might focus on a particular segment of the cybersecurity industry, like cloud security or endpoint security. This allows for a more targeted approach based on your investment goals. Question 3. Does the Cybersecurity ETF track a specific index? Yes, most cybersecurity ETFs track a specific index. There isn't a single cybersecurity ETF, it's a category of ETFs focusing on cybersecurity. Because of that, individual ETFs within this category will track different indexes. Here's a breakdown of how cybersecurity ETFs and their use of indexes work. Multiple cybersecurity ETFs. There are several ETFs focused on cybersecurity, each with its own investment strategy. Some popular examples include Global X Cybersecurity ETF, BUG, and ETFM International Cybersecurity ETF, IHAK. Tracking a benchmark, these ETFs don't directly invest in a random assortment of cybersecurity companies. Instead, they follow a specific cybersecurity index. This index acts as a benchmark that represents the overall performance of the cybersecurity sector. Index composition. The index will include a basket of stocks from companies within the cybersecurity industry. The specific companies and their weightage within the index will depend on the index's methodology. Here's why tracking an index is beneficial. Market representation. The index provides a way for the ETF to hold a diversified selection of companies in the cybersecurity space. This reduces risk compared to picking individual stocks. Performance reflection. By mimicking the index, the ETF aims to reflect the overall growth or decline of the cybersecurity industry. Examples of tracked indices. Inc. Cybersecurity Index. This index is tracked by ETFs like BUG. It focuses on companies involved in developing and managing security protocols. NYSE FactSet Global Cybersecurity Index, tracked by ETFs like ISAC. This index includes companies from developed and emerging markets that operate in cybersecurity. Question 4. If cybersecurity ETF is actively managed, who is the sub-advisor and what's their investment philosophy? The core concept behind a cybersecurity ETF is that it's passively managed. This means the ETF doesn't involve a team of fund managers actively selecting individual stocks. Instead, it tracks a predetermined cybersecurity index. Here's why active management isn't typical for cybersecurity ETFs. Index replication. The objective of a cybersecurity ETF is to mirror the performance of a specific cybersecurity index. This is achieved by holding the same companies in proportion to their weighting within the index. Active management would deviate from this by introducing stock selection choices. Lower costs. Passively managed ETFs typically come with lower expense ratios compared to actively managed funds. This is because they don't require a team of analysts and portfolio managers making investment decisions. Then who makes decisions? Index provider. The decisions regarding which companies are included in the cybersecurity index and their weightage are made by the index provider. This could be a financial data firm like SP Dow Jones Indices or FTSE Russell. They establish the methodology for selecting and weighting companies based on specific criteria relevant to the cybersecurity sector. Question 5. What is the underlying asset class of the cybersecurity ETF? The underlying asset class of a cybersecurity ETF is equity. Here's a breakdown of why. Investment in companies. Cybersecurity ETFs don't invest in physical assets, commodities, or bonds. Their core holding consists of stocks, also known as equities, of companies that operate within the cybersecurity industry. Focus on equity performance. By tracking a cybersecurity index, the ETF aims to capture the performance of the companies in that index. Since the index itself is composed of stocks, the overall value of the ETF is tied to the performance of these underlying equities. Examples of underlying companies. The specific companies held by a cybersecurity ETF will vary depending on the index it tracks. However, they would typically include firms that develop security software, provide cybersecurity services, or manufacture hardware solutions relevant to cybersecurity. Additional points to consider. Specific subsectors. Some cybersecurity ETFs might focus on particular segments of the cybersecurity industry, like cloud security or endpoint security. The underlying companies in such ETFs would be more concentrated in those specific areas. Global versus domestic. Certain cybersecurity ETFs might exclusively hold stocks from U.S. companies, while others could have a more global reach, encompassing firms from developed and emerging markets. Understanding investment types. Asset classes. In the world of investments, asset classes are broad categories that group investments with similar characteristics. Equity, fixed income, bonds, real estate, and commodities are some of the major asset classes. Why it matters. Knowing the underlying asset class of an ETF helps you understand the overall risk profile and potential returns. Equity investments, like those in a cybersecurity ETF, are generally considered riskier than bonds, but offer the potential for higher returns. Question 6. Does the cybersecurity ETF employ any quantitative investment strategies? No, most cybersecurity ETFs typically don't employ quantitative investment strategies in the strictest sense. Here's why. Passive management. The core principle behind most cybersecurity ETFs is passive management. This means they track a predetermined cybersecurity index. The index selection and weighting of companies within the index are determined by the index provider, not by the ETF itself. Index replication. The ETF aims to replicate the performance of the chosen index as closely as possible. This is achieved by holding the same companies in proportion to their weightage within the index. Quantitative investment strategies, on the other hand, involve using mathematical models and algorithms to actively select and weight investments. However, there are some nuances to consider. Index methodology. While the ETF doesn't actively choose companies, the index provider might utilize quantitative factors in its methodology for selecting and weighting companies within the cybersecurity index. These factors could include things like a company's market capitalization, revenue growth, or profitability ratios. Quantitative screens. Some index providers might employ quantitative screens to filter companies based on specific criteria relevant to the cybersecurity sector. This could involve factors like a company's investment in research and development for cybersecurity solutions or the strength of its cybersecurity product portfolio. Limited role of quantitative strategies. Focus on index. Even if the underlying index uses some quantitative factors, the ETF itself doesn't actively employ them to make investment decisions. It remains focused on passively mirroring the index composition. Question 7. How frequently does the cybersecurity ETF rebalance its portfolio? The frequency of portfolio rebalancing for a cybersecurity ETF depends on the specific ETF in question. There isn't a single cybersecurity ETF, it's a category of ETFs focused on cybersecurity, and each might have a different rebalancing schedule. Here's a breakdown of how rebalancing works in cybersecurity ETFs. Tracking an index. Most cybersecurity ETFs passively track a cybersecurity index. This index holds a basket of stocks from companies in the industry. Index rebalancing. The index provider periodically rebalances the index holdings to ensure they accurately reflect the target market segment, cybersecurity in this case. This might involve adding new companies, removing underperformers, or adjusting the weightings of existing holdings. ETF rebalancing schedule aligns with index. The rebalancing schedule of a cybersecurity ETF typically aligns with the rebalancing schedule of the underlying cybersecurity index it tracks. There are two main categories. Semi-annual rebalancing. This is a common schedule where the index is rebalanced twice a year, usually in March and September. Quarterly rebalancing. Some indices might be rebalanced more frequently, on a quarterly basis. Examples. First Trust Nasdaq Cybersecurity ETF, CIBR. This popular cybersecurity ETF tracks the Nasdaq Cybersecurity Index. According to the ETF's prospectus, the index is evaluated semi-annually in March and September. However, if a company becomes ineligible for the index at any other point during the year, it might be removed without being replaced. Question 8. What are the key risks associated with the cybersecurity ETF's investment strategy? There are several key risks to consider when investing in a cybersecurity ETF, stemming from both the general nature of ETFs and the specific characteristics of the cybersecurity industry. ETF-related risks. Market risk. This is the inherent risk of any investment tied to the stock market. The overall performance of the cybersecurity ETF will be impacted by fluctuations in the stock market. A downturn in the broader market could lead to a decline in the value of the ETF. Tracking error. While a cybersecurity ETF aims to mirror the performance of its underlying cybersecurity index, it might not achieve this perfectly. There can be a slight tracking error, meaning the ETF's returns might deviate somewhat from the index's returns due to factors like expense ratios and fees associated with managing the ETF. Liquidity risk. Although most cybersecurity ETFs are traded on major exchanges, there's a chance that their trading volume might be lower compared to ETFs that track broader market segments. This could lead to lower liquidity, making it slightly more challenging to enter or exit your investment position quickly. Cybersecurity industry risks. Rapid change. The cybersecurity landscape is constantly evolving. New threats emerge frequently, and companies need to adapt their solutions to stay relevant. An ETF that holds on to outdated cybersecurity companies could underperform if they fail to keep pace with industry advancements. Regulation. The regulatory environment surrounding cybersecurity is complex and constantly changing. New regulations could impact the way cybersecurity companies operate and potentially limit their profitability. Competition. The cybersecurity industry is a competitive space with a growing number of players. This competition can put pressure on margins for cybersecurity companies, potentially affecting their stock prices and impacting the ETF's overall performance. Cybersecurity breaches. Ironically, cybersecurity companies themselves are not immune to cyber attacks. A major security breach at a company held by the ETF could damage its reputation and stock price, impacting the overall value of the ETF. Question 9. Does cybersecurity ETF contribute to portfolio diversification? A cybersecurity ETF can contribute to portfolio diversification, but it depends on how your portfolio is currently structured. Here's a breakdown of the diversification potential and limitations to consider. Diversification benefits. Exposure to a specific industry. A cybersecurity ETF offers exposure to a specific industry, cybersecurity, which you might not have through other holdings in your portfolio. This can help spread your investment risk across different sectors and reduce your overall portfolio dependence on any single company or industry. Multiple companies within the industry. Instead of picking individual cybersecurity stocks, a cybersecurity ETF holds shares in numerous companies within the sector. This diversification within the cybersecurity industry itself helps mitigate the risk associated with any one company underperforming. Limitations to diversification. Concentration on tech sector. While the cybersecurity industry is distinct, most cybersecurity ETFs are heavily weighted towards technology companies. If your portfolio already has a significant allocation to technology stocks, a cybersecurity ETF might not provide much additional diversification benefit. Correlation with broader market. The cybersecurity sector can still be correlated with the broader technology sector and the overall stock market. This means that during market downturns, the cybersecurity ETF might decline alongside other stocks you hold. How to enhance diversification. Combine with other asset classes. To truly benefit from diversification, consider including the cybersecurity ETF alongside investments in other asset classes, such as bonds, real estate, or commodities. This can help create a more balanced portfolio with reduced overall risk. Look beyond technology. If you already have a significant tech exposure, explore cybersecurity ETFs with a broader industry reach. Some might include companies beyond pure software development, like those involved in cybersecurity services or hardware solutions. Question 10. Are there other ETFs with similar objectives of cybersecurity ETF, but lower expense ratios? Yes, there are several ETFs with similar objectives to a cybersecurity ETF, but potentially lower expense ratios. Here's a breakdown to help you compare. Cybersecurity ETF objectives. Industry exposure. The primary goal is to provide investors with exposure to the cybersecurity industry. This allows them to capitalize on the potential growth of this sector. Passive management. Most cybersecurity ETFs are passively managed, meaning they track a specific cybersecurity index. This offers a diversified approach within the industry without the need for active stock picking. Finding lower expense ratios. Expense ratio comparison. Here's where the key difference lies. Expense ratios represent the annual fees associated with managing the ETF. Lower expense ratios translate to keeping more of your returns. Popular options. ETFM International Cybersecurity ETF, IHAK. This ETF tracks the NYSE FactSet Global Cybersecurity Index and has an expense ratio of 0.47%. iShares Cybersecurity and Tech ETF, IHAK, tracks the ISE Cybersecurity UCITS Index and has a slightly lower expense ratio of 0.47% compared to ISAC, but offers a somewhat shorter track record. PSDXT's Trackers Cybersecurity Select Equity ETF. This option, with an expense ratio of 0.2%, tracks the Solactive Global Cybersecurity Leaders Index. It might be a good choice if you prefer a European domiciled ETF. Important considerations. Underlying index. While all these ETFs aim for cybersecurity exposure, they track different indices. Research the specific index methodology and holdings to understand the nuances of each ETF. Performance. Expense ratio isn't the only factor. Compare the historical performance of these ETFs to see how they have tracked their respective indices. Additional features. Some ETFs might offer features like dividend reinvestment or currency hedging. Consider these depending on your investment goals. Remember, cybersecurity ETFs are a great way to gain exposure to a booming industry, but they're not without risks. Here are some key takeaways to keep in mind. Diversification is key. Don't put all your eggs in one basket. Consider adding a cybersecurity ETF to a broader portfolio that includes other asset classes. Research is crucial. Before investing, understand the specific ETF's underlying index, expense ratio, and holdings. Fees matter. Look for ETFs with lower expense ratios to keep more of your returns. We mentioned a few options in the video, but there are always new ones emerging. The cybersecurity landscape is constantly evolving, so stay tuned to Chat ETF for future updates on this exciting investment arena. In the meantime, let us know in the comments below what other tech-related ETFs you'd like us to explore. Thanks for joining us. and we'll see you on the next episode of Chat ETF.